Good morning. My name is Britton Brown. I'm with Trade Hive. Just going to get right into it. I kind of did last couple of days an introduction, but if you're interested in learning more, you can either go to tradehivecommunity.com or you can look at the previous day's market playbooks for the NASDAQ. That's what I'm covering today. I will be posting probably crude oil and gold on the website as well. I put the playbook on my website so you guys can go check it out. I want to get right into it because we've got some interesting things going on in the market that I think you need to be aware of. Specifically, what's going on with gold and what's going on with the currency market with the US dollar, and then where we are with the market and what's going on with institutional players. So with that said, I'm going to switch over. Let me get into the charts real quick, and we'll kind of go from there. I think this will be helpful for you. That's the whole point. As I mentioned before, I've been doing this for 30 plus years. So as a professional trader, I trade real capital, and basically I started this to help those traders that are trying to become professional traders, or at least trying to make a living doing this some way, sort of another. You're probably a prop trader if you're looking at this and struggling. That's the whole point. You're getting a lot of terrible information based on the videos I've seen on YouTube. So anyway, I'm going to switch over. This is my heat map, specifically the S&Ps and the NASDAQ. But I'm going to flip over and let's start with the daily. I'll break this down for you. And what I'm looking at specifically, as of right now, price is sitting at 26,190 in the NASDAQ. That's where it was approximately an hour ago, a little bit more than an hour ago when I started working on this. If you're unaware, I do this every day on my website. I decided to try to give YouTube a shot here and see if I can't reach a few more people. This information is free. The paid membership aspect, the trading room, that sort of stuff, that's obviously separate, but this is there to help you. I also put out an overnight markets macro review for the general markets, what's happening around the world, and then I even do a crypto macro review for those that like the crypto scene. So what you're looking at right here is the daily. The boxes that are on here, just so you understand, are consolidation. So I trade Wyckoff. We call it the master pattern. Basically, you have consolidation, you have expansion, and it kind of tells us where we're at. This is the daily chart. So the trend lines that you see, the red, the green, the white, specifically are based off of imbalances. Some of you with ICT call fair value gaps, whatever that is for you. That's an imbalance for institutional traders. So we want to see how this market is progressing. The red on the daily is going to be your monthly, the green is going to be your weekly, and then the white is the daily. We are currently above all three of those. The 9 EMA is above the 32. That's important to know because that's giving us directional bias. We're still working off of a failed red box, so that's something that you want to be privy to. We shot up, we failed to continue further up, then we popped lower underneath the box with a projection down well below this market. Didn't see us getting there. The trend line held on the daily until just last week. We cracked it. And then responded once again, and we're back in that trend line. That's important to understand. We have institutional liquidity on the sell side waiting for us to go to all-time highs. I can tell you, I speak to institutional traders every day. Not supposed to know some of this stuff, but I will tell you that, it shouldn't take you that long to figure out that institutions sell when it's strong and they buy when it's weak. And so there are certain times, because I have an institutional background, that we have risk managers that are on the floor. Their job is to make sure that we are in compliance. What that means, so you understand, is that when the market gets to a place where we have good profits in it, we will start taking off. We may still love the trade from an institutional standpoint, but we will start reducing risk by taking some of the risk off the table. We're in that zone right now. we are, even though we're in a bullish trend, we are in a very large, very wide consolidation or a balanced market. So right now we're in premium. This is when they need to be taking some risk off and wait for this market to show us that we can continue higher. What is that going to take? We're going to have to take all that liquidity out and continue higher from the all-time highs. So with that said, we do have a lack of progression off the current box. We are in a compression risk. What that tells me, we are neutral to bullish, but this market is very fragile. All right, so let me flip over. Let's get over to the 4 hour. Let me get over. This is where things get very interesting from my perspective, okay? We have popped, we're in consolidation mode right now. We're in a gray box off the gray box on the 4 hour. The fair value, that is the median, right, of that box sits at 26,141.50. That's kind of, for me, a little bit of the line in the sand, even though that sits above the daily trend line, which you can still see. Every time I see a gray box at the high end of a market structure like this, if it cracks, it is substantial. Okay, so you need to keep that on your radar. The 90 MA is above the 32, so we have that matching up with the daily. That's giving me a trend bias to the upside, but like I said earlier, it's a fragile market right here. It's kind of do or die. We're either going to go up and get this thing rolling, or this thing could get nasty real quick. If that breaks, then you have two scenarios that will happen, okay? The 90 MA on the 4 hour is starting to curl over. That's going to give you a little substance to that protection aspect. It's going to make some funds nervous, okay? They're watching it. It doesn't mean we're going to crack. It just means you need to know about it, right? We can pull back, get underneath that fair value, that 26,141 today, and we can pop back up. We could go down. We could make a push lower to basically as a liquidity run to generate the retailer sellers to show up, think the market's crashing, and then immediately get back in that box. So you're looking at the box right here, right now. Why don't you mark your charts on a 4 hour? This will be helpful. If we go down and we spike lower, leave a wick, and then we start heading back up and we get above the fair value, that is typical. Let's fool the retail market. Let's get some more longs going, and then let's go make some new highs. However, like I said, if this market starts to crack, you will not see institutional buyers show up until you get down below 25,850. Okay, so I said it yesterday. I think I said it the day before. Institutions are not playing from a long-term game plan to make 100 points. They are looking at a minimum of 800 to 1,000, 1,200 points in a move. All right, so you can tell that they've put a cap on it up in this area. If you're watching this market, it's pretty obvious with the S&Ps. They get up to that 7,000 level, and they cannot get anybody to continue on. Think of it like this. When you have a buyer and a seller, one guy thinks it's going higher, one guy thinks it's going lower, right? Thinks it's cheap, the other guy thinks it's expensive. Who's going to win that battle? And what is going to entice whichever trader is going to win, right? What's going to bring more sellers for the seller or more buyers for the buyer? I don't have much of a reason to be long above 7,000 in the S&Ps, and I don't have much of a reason to take a long up here, which means that the probabilities are going to shrink to the long side, and we're starting to see that. The last couple of days, we started out 2 days ago with 64% probability that we were headed higher, and yesterday it was a little bit lower. Today it's even a little bit lower, right? Point is we're running out of steam up here. So 4 hour is neutral with downside risk. I'm watching the gray box. That's going to be a catalyst right here. Let's get over to the 1 hour. And again, yesterday on the 1 hour, we had popped a gray box. You can see that right up in this area up here. We have been stacking this green box with a red trim. That is a high volatility box. Usually, as I mentioned yesterday, when we have those about 3/4 of a range in whatever direction on the upside or the downside, we have a changing of the guard. And so that volatility, that expansion of the market happens. It confuses retail traders. It confuses institutional traders from that standpoint. But know where you are. That's the whole point here. Know where you are when you're looking at these charts here. So on the 1 hour, we failed on the gray box. Fair value of that box is sitting at 26,292.50. The 9 EMA is above the 32, but we are pinching, right? We had great expansion between the 9 and the 32 on the way up, and now we're coming together. This thing is looking like it might roll over. When these things cross, oftentimes we will see a significant move. An hour could be 300 or 400 points versus a 4 hour could be 800 to 1,000 in this market. So the 1 hour is a bearish rotation with larger uptrend. Know where you are so that when the market does start to, when you see buyers coming in and absorbing, who's going to absorb and take a shot to the long side? It's going to be your hourly traders that are defending a position. If they throw in the towel, that's when the 4 hour guys and when the institutional traders start to really hammer this market. So you need to be aware of it. From a 5-minute standpoint, this is basically my entry, should be your entry. Don't get confused. I only look at this chart when I'm looking to execute a trade. So from that standpoint, we are working on a green box with red trim. Again, that is high volatility regime. So that is confusion on the retail side of things. Institutional guys aren't really looking at this, right? So you're a momentum trader if you're trading this. On the 5-minute, we are in a, I always say, hey, look, when you have a green with a red trim box, it's almost like you're in V-fib. If you know anything about cardiology, things aren't making sense and it's going to shake you out. So, you're going to need a little bit wider stop if you're playing these things. I've got a downside target. That downside target off this, you can see, let me just back up. We tried to the upside, and that upside target was sitting just about at 26,226. We did not make it there. All right, we've got the 9 below the 32, and we can see that we are progressively making lower highs and lower lows. That target sitting down at right around 26,135.25 is in play. Now, we're used to hitting targets to the upside and hitting targets to the downside. This fair value right here sitting right around 26,191.25 is at play. We're going to try to, we've come down, we're going to try to get above it. This blue line right through here is the VWAP, and that's a continuous VWAP. They're going to try to reclaim this and make the run back up. If we don't see them, we have some more sell side liquidity. This is where people are going to come in right around 26,222. Should see some selling right there. We are under the green trend line. We're just above the white, and we're under the red. And again, those are imbalanced trend lines, not necessarily a trend line you're used to looking at. I still think that lower end target is going to be in play, might come in the morning. So keep that in mind. We had some economic numbers come out. Unemployment was pretty much in line. We had a couple other numbers show up this morning. We've got more numbers coming out at 9 a.m., so be aware of that. Ultimately, let me just get right to the main point here. On a probability matrix, you can go and locate this on my website. Downside expansion probability is 58% now, right? The last couple of days it's been 60, 54, 64% to the upside. Well, we're seeing this market change hands, and so we have a higher probability of the downside. Chop balance continuation sitting at 27% probability, and an immediate breakout to the master pattern to the upside is sitting at 15%. Now, I always say, when I have a low number like a 15 or a 10%, that is a red flag for me. So I don't discount it. What I'm saying is I want to know, hey, if this thing gets rocking, where are the masses trading to? So I'm going to leave you with that. Again, I hope this is helpful. I'm trying to, basically the whole point here is to help you formulate your bias. I'm not here to make a trade for you. I'm here to endorse what you're doing, and at least if I'm not on the same page that you're on, give you something to think about. When you make trades, I always tell people, look, risk first. Risk first. Make sure your risk units are in line, meaning you're not going all in, you're not risking more than 1% on a trade. I can tell you that this is, from an institutional, from a professional standpoint, I never take a trade without knowing what my risk is, understanding that yes, I have an edge, but I have no control. I'm not big enough to move this market on my own. So I'm playing the mindset of other traders coming in and supporting whatever my thesis is for that trade, right? My idea for that trade. So I always look at it like, hey, here's my risk. If I'm risking 1% of my account, that's my max risk for the day. I typically go in at quarter RUs, meaning a risk unit is 1%. For the day, I might just start at a 0.25% to start on a trade. My first trade, see how things go. Am I in line, right? Because I can't really control what somebody else can do. I can see a pattern. I can see the things that make sense, but one trader can wreck that whole idea. So my stops are in place. A loss is a loss. All a loss is to me is data, right? So I will plant this seed with you. You got to get into the probability mindset. If you want consistency, this is what I'm going to leave you with today. If you want consistency as a trader, it's all about probabilities. Think of it like a casino, right? Casinos don't care. They never lose money at the end of the day, right? They are playing the probabilities on the long side of things. As a retail trader, as a prop trader, I promise you're probably over leveraging. I mentioned yesterday the sweet spot, 48% to a 54% win ratio is about where you want to be if you're going to be successful. If you're trying for those 70 and 80%, or maybe you're in search of the Holy Grail, that tells me you're a fear-based trader and that you are ultimately going to lose money. You're probably trading on a 1-to-1 ratio. You will not succeed in this business. So again, probabilities, losses is just a data point for you. You should be journaling that, specifically journal on your emotions. But again, this is a probability game if you want to be in this for the long haul. I appreciate your time. I hope that was helpful, and good luck trading today.